Hey, how's it going? So, question today is how do crypto taxes work? Now, as the question alludes to, Bitcoin has enough legitimacy already to the extent that governments take it seriously enough to tax it. And I will say straight up that tax treatment is different all over the world, and I'll give you a flavor of that in this video, in this audio. But there are some generalities that you will see in most countries. So for tax purposes, crypto is treated in most places, including I believe the US, as an asset. It's kind of very similar to holding, like, I don't know, a commodity, or maybe a more classic example is holding stocks, right? And if they increase in value, then the government wants a percentage of that increase. They want, like, I don't know, depends on the country, but let's just say it's typically around 20% or something like that. So if you buy Bitcoin and you hold it and it doubles in value, you know, they want a piece of the profit that you're making. Now that's the key there, right? When you sell it, you're making they call that a realization of the gain, the capital gain. The overall tax is called capital gains tax, applies to holding any kind of asset. And when you realize that gain, when you sell that asset, you realize the profits, right? They hit your bank account, and at that point the taxman wants some of that money. Now, there isn't such a thing yet in most countries as unrealized capital gains tax. Some governments are starting to talk about it, but most people see it as very, very unfair. Most people say, look, don't tax me while I'm still holding this thing, you know. Tax me when I profit from it. I mean, the classic example is owning and living in a house, right? You know, if your house price goes up, imagine the government says, well, I want a piece of that money. You know, your real estate, your price has gone up. You owe me now. And you're like, well, hang on, I haven't even sold the thing yet, and I'm relying on it, and I'm sitting in it, and it might even go down, right? What are you going to do then? You're going to pay me back the money? In theory, they say yes, but it's just generally, most people think generally it's just a bad idea. Let me make the profit, and then I'll pay you the tax, because I'll have the money sitting in my bank account then. So that's how it works in most countries, capital gains tax. And when you realize that gain, when you make that profit, then that's when you pay it. Now, if you make a loss, that is also can be offset against your gains. And this is a general principle in taxation the world over, that if you make a loss, it's the same if you're just doing your income taxes, but if you're making a loss, then you know it should be offset against it should be taken into account. Basically, you shouldn't, you know, if they're going to pay taxes on, if they're going to receive taxes based on what you make, then equally you should kind of get a tax credit if you lose, because at the end of the day you took the risk, right? And why should the government only benefit when you profit from that risk, but when you lose, you know, they're like, well, we don't care anymore, you know? It's you know, it's all your loss. Well, that's kind of not fair, really. So yeah, you can also offset for tax purposes losses as well. That's generally how capital gains works. I'm not a tax accountant, obviously. I'm not a financial advisor, but that's generally how it works. Now, some countries actually don't have a capital gains tax, yeah, people are quite lucky in that respect. But most countries do have capital gains tax, including the US. Now, there's some countries that don't have a capital gains tax. There's a few rare countries that have a different tax on assets, and it's a wealth tax. And depend on any given time, you know, maybe on the 1st of January every year, they look at all your assets and they work out some percentage of that you got to pay as tax. And it's a bit similar to the situation I mentioned before of paying tax on unrealized gains, So it's like being in a house. Your house goes up in value, and the government says pay tax on that, even though you haven't sold the house yet. So yeah, some countries have a wealth tax, and that includes crypto. Now, is that, a lot of people say that's worse, but hey, if it actually works out to be less than what you would pay if you were profiting from crypto, it might actually not be such a bad thing. So for example, if you make massive gains on your crypto, you're going to have to pay a fair chunk of that, depending on how much you're holding, to the tax man in the form of capital gains tax. But if there's just a wealth tax on your crypto, it's not really based on your gains. It's based on the total asset value. It actually, for crypto, could work out better. Really depends on your situation. But anyway, typically you won't have a choice in the matter unless you're willing to move country. Typically, you're just going to have to pay whatever they want, and in most cases, it's going to be capital gains tax. Now, I do also want to mention another type of tax. The taxman can look at you and say, right, we don't think you should pay capital gains tax. However, we think you should pay income tax instead. Or, maybe some professionals are actually using a company instead, in which case you would pay a different kind of tax. But let me talk about income tax. So if you're someone who does a lot of heavy trading, and that's how you're making your money out of crypto, you're not making crypto by betting long, going long on Bitcoin and waiting years to profit. That's called investing. If instead what you're doing is betting big and making very small percentage profits, but every day you're making some money on crypto, you're basically day trading, then that's different. You're making money out of day trading. You're not buying and holding. In fact, you don't even care what the capital, you're not concerned about whether Bitcoin even goes up in the long term. What you're doing is you're looking at those chart patterns on a daily basis. And we don't really call that capital gain anymore. You're just looking for price action. You're looking to quickly secure profit from price differentials. That is considered making money from your trading activity and not from investing. That is not capital gains. I mean, some might argue that it is. It's just on a very narrow time scale. But the government doesn't see it that way. The government says you're just making general profits from trading activities, which is very similar to having income, and therefore we're going to treat that as part of your income, and we're going to charge you income tax on that. So if you're a day trader, tax will be treated like income tax. But for most people, they're not doing it like that. Most people are trading. I don't know, maybe most people are investing in crypto. They're either holding it for a long time, maybe they're occasionally changing their holdings, doing a rebalancing. That's okay. You could be DCAing, you could be adding to your position every week, or even every day. That's not trading. You could be generally holding, but occasionally selling, maybe a dozen times a year. That's okay. That's still regarded as investing. That's still capital gains tax. You're not doing this kind of heavy activity of trading every day and relying, and getting an income like that. That's totally different. So in general, you'll probably be paying capital gains tax on your crypto holdings, and the tax will in general be charged when you realize the profits, i.e. when you sell, when there's a sell event. So I hope you found this video useful. Let me know what you think. Leave a comment below. I'm not a tax accountant. I'm no substitute for you doing your own research and seeking real professional assistance if you need it. Just wanted to say that. Anyway, I'll see you again soon. Take care. Bye-bye.